There's two main types of crypto arbitrage strategies that are deployed within crypto. How much money can we make from these? Are they easy to carry out? And what are the risks that we actually have to take? I'll talk about that in this video. The most popular type of arbitrage trade within crypto is what's known as funding arbitrage. This can happen through exchanges, or you can actually buy some tokens where the projects do this arbitrage themselves and essentially pass the yields back to you after taking their cut. So let's go through what exactly this is and how we can actually go ahead and implement this. So an arbitrage is where essentially you take zero or very minimal risk in the trade in terms of you're not just buying or selling or hoping the price to move. Essentially, an arbitrage is where the price moving doesn't matter and you're taking some other yield out of the strategy. The way that this happens with funding rate arbitrage is essentially you create what's known as a delta neutral position, which is where you don't have a long position or a short position. So how do you go ahead and do that? Well, you buy some crypto in the spot market. All right, so let's say you buy one Bitcoin, and so you have a Bitcoin long. Now, if you just did that, the price would move up and move down, and you would actually make losses and gains. So there's no arbitrage there. You're just taking risk. So what you do to cancel out that long position is sell one Bitcoin in the futures market, right? So now, if you think about your total position, what you have is one BTC long, and you also have one BTC short, which is in the futures market. It's in a synthetic trade where you take a short position. So you can go in the futures market, you can say, look, here's some money to collateralize this position. I'm going to take a short position. And so essentially you've got a trade that benefits when the price goes down. So your overall position is one BTC long, one BTC short. Therefore, your overall position in the market should be essentially no position whatsoever. If the price moves up or down, each of the positions, cancels each other out. That is known as taking a delta neutral position, or a position where the risk that you have is not within the price movement. So why on earth do that? Well, this side of things in crypto, the futures market pays something called a funding fee. Now, funding fee is something that is either paid or received. If you sell short, you can receive funding. Now, sometimes if you sell short, you actually have to pay funding as well. This is one of the risks of the strategy, is that this funding can either be paid or received. Now, most of the time in crypto, it is paid by longs and received by shorts. So essentially what's happening here is you have a position of no Bitcoin in the market, but this side should pay you some percent on the funding rate for your short position. So what you're doing is creating delta neutral, no market risk, and just creaming off whatever this may be on this side. There are risks here. The execution risk in doing it. When you do this, you have to use centralized exchanges. So you have a platform risk. What if the centralized exchange goes belly up? What if they, lock up your funds in some way? What if they get regulated and there's an issue there? That is a risk. There's opportunity risk, because if you have a market neutral position, right, as in you don't have any Bitcoin and you're in a bull market, you may make 10, 20% from the funding rate, but Bitcoin's up like 150%. So what one would you have rather been in? And then there's funding rate risk, like I said, because the funding rate is mostly positive, meaning short sellers do get and receive that funding, but sometimes it isn't. Here's how it works and how it looks like. So you can actually carry out this arbitrage strategy on a couple of different platforms. Binance does this, OKX does this. I know for sure if you have other trading bot platforms, they may do this as well. So I'll show you on Binance. So arbitrage bot in the trading bot section. This is what it looks like. So this is their entire arbitrage bot platform. And essentially what you have to do is find the strategy on the left-hand side, and they give you this. They actually do the whole entire thing. So you don't even need to work this out. Now, before this was created, you had to actually carry this out yourself. You had to go figure out how much spot you needed, how much futures you needed, net them off and everything. Well, now, literally just Binance have this platform. So what we need to do on the left-hand side is go to positive carry. Most of the time in crypto, there is a positive carry. So you want to do that one, because what you're doing is taking funding rate from the short side in the futures market. And then you can see sell the futures, buy the spot, sell futures, buy spot, sell futures, buy spot. It doesn't matter which coin that you're trading. It's irrelevant, because essentially what you have is a market neutral position. So you don't care what the price does. You just care that the funding rate is high and you're receiving that. So for right now, you can see it's mostly around 10% on Binance. Each platform is a different market and therefore will have completely different funding rates. Although they're, mostly similar, of course, because people are trading between the exchanges, but 10% for the Bitcoin arbitrage, 10% for the Ethereum arbitrage here, and some other coins down here, which may be more or less. Funding rates can change, like I said, but for right now, it's around 10%. So look, you've got the spot side, you've got the futures side, but you don't need to worry about that. On the right-hand side, this is the strategy that will be open for you. Literally on Binance, you just put an amount in that you want to trade with, and that's it. Now, I opened this one yesterday just to show you what a live position would look like. So I opened it yesterday. This is ETH arbitrage. I went long spot, short futures. I didn't choose anything. I just literally pressed create. Put $100 in here, which is obviously nothing, but total funding fee you can see. So I've actually earned this much over the day. So you can work this out as a percentage. I just did $100 here, so you can work it out as percentages on whatever you would want to invest in. But a 10% annualized rate, I'm getting those funding fees, and so I've earned the funding fee right here. You see the market value and the duration. This is working. I can end it right here. This is on Binance anyway. So what you're doing is essentially putting dollars in, and you should have a market neutral position. Therefore, it's essentially like dollars, right? So you've got dollars in, and you're just earning a yield out of that arbitrage. And the whole point of this is that whatever the ETH price does, it doesn't actually matter. I do have deposit bonus links to Binance and the other platforms I use. I'll link them below if you are interested. You want to use those platforms anyway. Now, in some jurisdictions, you can't trade futures on these exchanges. It just, they won't let you because of whatever reason. So there are other ways to carry out this strategy, but they include more risk. I don't want to say that's good or bad or promote any project. I don't want to do that. I think there are more risks here, but I want to explain what those are. If you're searching for a crypto arbitrage video, I just want to give you the information. This is Athena, which is a project that is very popular in this crypto cycle, and they're carrying out this exact strategy. So what they're doing is they're buying Bitcoin. So essentially people are giving them dollars, right? So here's $10,000. I want you to carry out this funding rate arbitrage trade for me. So you put 10,000 in, and they give you a receipt for that 10,000, which is known as USDE, which is they're marketing this as a stable coin, but really this is what it is, right? It's a dollar liability that they have to you because you're giving them your money and saying, carry out this strategy. And if I want my money back, give it back to me. So what you're doing when you're giving them dollars is giving them your dollar liability. They now have $10,000. If you give them $10,000, they now have a $10,000 liability to you, as in you have in your rights to call that $10,000 back. Therefore, they now have a dollar liability to you. What they're doing is taking that $10,000 and attempting to carry out a delta neutral trade in Bitcoin and ETH. Now, what they're doing is using centralized exchanges to do this. Binance, Bybit, OKX, you can see them here. So they're buying an amount of Bitcoin and ETH. They're putting it into this strategy. They're then taking the opposite side in the futures trade, just like I showed you in this, and they are creaming off the funding rate. So what are the risks here? All the same risks that we saw down here in the bottom left, platform risk, etc., plus more, because now you have another project team in the middle. So they are a project team who are trying to manage this, very large positions. Things can go wrong, with smart contracts or the trading or anything else. This team could get a big regulatory, investigation. Maybe they can't take the money out when you want it. What happens in a bear market when everyone always wants their money out? Are they going to be able to take these positions out of the market and give everyone their money back? So these are the risks associated with using projects. In any case, if we look at what they're doing, it's exactly the funding rate arbitrage that I told you right here, which is they're going and buying Bitcoin and ETH right here. This is the current APY, right? So around 10% on most platforms, maybe a little bit more on some others. But again, these can change every single day or every 8 hours or so, the funding rate changes. This is what they're doing. This is what they're carrying out. So buying in the spot market, selling the futures, taking that. The current APY, as you can see here, is about 8%. And the open interest, they have a lot of open interest. They have 7% of average. They have 7% of open interest in terms of the futures market. So, they're a fairly big player. But that's what they're doing. It's this funding rate arbitrage. You can use stable coins like USDE if you want to carry out the arbitrage and let them do it for you. Look, I don't recommend it. If you're holding dollars, right, you're holding that because you don't want to lose the dollars. You're basically giving your money over to what is essentially right here an unregistered, unregulated hedge fund. That's what they're doing. This is unsuitable for most people, and they probably shouldn't be taking your money. Therefore, they are probably unreliable as a partner, right? If someone is offering you a product that's unsuitable for you and they're not carrying out all of the regulatory checks, they're therefore untrustworthy, and so you can't use them. I just want to show you that that's what they're doing within crypto. This funding rate arbitrage is something that is carried out by many different parties as well. The other type of arbitrage that we can carry out is a spread arbitrage. Now, a spread arbitrage is where you try and take the price difference between the price that the spot market is trading and also some futures expiry in the future. So the funding arbitrage here, this relies on trading in the futures market known as the perpetual futures market. Perpetual futures are synthetic contracts with no expiry date. There are also contracts with expiry dates, as you can see here. So what happens with this type of arbitrage is that you're trying to buy and sell an asset with this future expiry. So you buy spot, you sell the future with the expiry, and there may be a spread between that you can arbitrage out. Now, the reason this is known as an arbitrage is because you're trying to buy and sell at the exact same time. This is actually a futures contract, so you have to sell it in the future, right? So you're buying spot, but you're agreeing at the exact same time to sell that exact same amount in the future at that day at the price. And there will be a spread between this, of course, right? Because futures contracts price in what people think the price will be in the future. So let's go through that and see what it looks like. This is actually available on OKX. I've not seen this on other platforms, but if you go to the arbitrage trading box, you can come up here, go to spread arbitrage, and then you can see the different APYs, right? Now, they say this is an APY, but really what it is just a price differential between the spot price right now and what you can sell the futures contract at. You can see the current futures expiries are September to December. So this is the 27th of Sep, the 27th of December here, right? And so what you're doing is buying spot, selling future right here. But there's risks here, right? Because essentially what you're doing is saying, yeah, sure, I'll take this, 10% price difference between now and September 24. Sure, I'll just take it right now. However, you've got opportunity risk here because that price may fluctuate wildly. And if you just held the asset, then, you may have made way more money, but of course you're taking more risk then. So what you're trying to do here essentially is just say, look, for the next few months, I mean, this is 6 months away, is 7% a good yield? I would say with Bitcoin, no, right? Because Bitcoin annualizes around 50, 60% right now. So even if you just hold for long time periods, then you're going to be getting annualized rates around that if you're, dollar cost averaging over time. So look, it's an arbitrage. And so yields actually should be much lower than taking risk. But what you're doing is buying spot now and agreeing to sell at that date in the future. And of course, your money is tied up in that trade until you buy it and obviously sell. And when that contract expires, then the money is transferred. So it's an APY, as they call it, but it's essentially an arbitrage trade where, yes, you can carry it out, but over time, it may yield a lot less than other types of strategy, but that's up to the individual. And again, you have the same risk, which is your money's tied up on a centralized platform. If you're using the top 5, top 3 exchanges, then I'd say they don't have much risk of going bust or something, but your money's always tied up on a centralized exchange. That is a risk. And then, like I said, opportunity risk is major as well. Ironically, the most money you're going to make from a funding rate arbitrage, the strategy at the start of this video, is in a bull market because people are willing to pay higher prices. That pushes up the price in the futures market. Longs have to pay more in funding to shorts, and therefore the yield that you're getting is higher. In a bull market, of course, you'll be missing out on capital gains from the assets going up in price. However, an arbitrage is supposed to be different than that. You're supposed to not take price risk, and the risks that you have are only in opportunity cost and platform risk that you may be using. In any case, in bull markets, you should be getting higher funding. In bear markets, funding can go negative, and that's not good because that means that your position will actually be paying out that negative funding, which isn't great. So there is risk within the funding rate, if not in actually taking any price risk in the market. Hopefully that explains the risks and some of the ways we can use arbitrages Links to Binance and the other exchanges I use down in the description below. I'm James, this is MoneyZG. Cheers for watching, and I'll see you in the next one.